Hi, welcome to STANLIB's weekly economic podcast. My name is Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think we need to focus on the US inflation data that was released for the month of April, both CPI and PPI numbers out last week, and both surprising to the upside. If we break down some of those data points, we can see that energy or higher energy prices are a key component of the upward trend in inflation, but there's an increasing array of evidence to suggest a broadening out of some of the inflationary pressures, and clearly that will raise concerns within the Federal Reserve, and I think it is changing inflation expectations. Outside of US inflation, there wasn't a huge amount of information released within South Africa. We had our mining and manufacturing numbers. The mining numbers were disappointing, manufacturing slightly better, but overall you would say we're really struggling to gain momentum within our productive sectors. If I break down South Africa's growth, it's still heavily dominated by retail activity and financial services. And the sectors we would ideally want to see are doing a lot better, they're just struggling to gain momentum. That's mining, manufacturing, construction, really under persistent pressure. And I think if South Africa is to try and lift the growth rate more meaningfully, we have to broaden out the nature of South Africa's growth. We can't just rely on one or two sectors if we're going to try and achieve a 3 or 4% GDP outcome. South Africa's focus will now shift to the next MPC meeting. That's next week, Thursday. I think there is now a general consensus that the Reserve Bank is likely to increase interest rates by 0.25%. That expectation is coming about partly because of the successive increases in the fuel price, the fact that the oil price remains over $100 a barrel, and I guess recent comments from the Reserve Bank themselves regarding their desire to adhere to the 3% inflation outcome. That doesn't mean that hiking interest rates is going to miraculously bring inflation under control, but the Reserve Bank has to try and manage inflation expectations, and it has to try as much as possible ensure that the inflationary pressure doesn't spread or broaden out into a broader array of categories and therefore become entrenched at a much higher level. So I think during the last month, systematically, most economists have moved their thinking away from interest rates remaining on hold to a likely increase in interest rates, with the possibility of an additional rate hike before the end of the year. So not a great scenario, but it does depend on what happens to the oil price over the coming weeks, over the coming months, and clearly if the oil price were to move down convincingly to about $70, $80 a barrel, then a lot of these pressure points would dissipate. And under those circumstances, there would still be scope for the Reserve Bank to cut interest rates. But I think in the short term, the Reserve Bank is going to be very concerned that the progress we've made on bringing inflation under control, that a lot of those gains are going to now be eroded by the higher oil price and the risk that those inflationary pressures spread into a broader array of categories. So for this week, we'll focus on the US inflation data, and then next week we'll be able to talk about the build-up for the MPC meeting and any other data that becomes known at that stage. Let's drill down into the US inflation data for the month of April. At a headline level, the CPI went up 0.6%. That's certainly high under any circumstance, which pushed the annual rate of inflation up to 3.8%. And in the last couple of months, US inflation has been moving successively further away from the 2% target. Unfortunately, if I look at the gasoline price in the US, which is now up about 42% year on year, it's clear to me that not all of that is yet reflected in the inflation data. The April number showed a gasoline inflation rate of about, I think it was 28%, which tells us there's further pressure that has to be reflected in the data, which presumably will show up in next month's release. At a core level, inflation went up 0.4%, which is also on the high side and exceeded expectations, which pushed the annual rate of core inflation up to 2.8%. 2.8% it's just too far away from the 2% target for the Federal Reserve to really feel comfortable. And then in addition, producer inflation came out way ahead of expectations. It shot up to 6%. With a month-on-month increase of 1.4%. So if we look at all the main inflation numbers, they clearly are elevated. They're clearly moving in the wrong direction. And when we break down the components within the inflation data, there's evidence that this isn't just purely an energy effect. Yes, energy is a key component of the latest acceleration in inflation, but if I break down the US data, there was a large increase in shelter inflation, which is really the rent of properties. And some of that was anticipated given the new survey for rental inflation. But even then, I think it exceeded expectations. And clearly now shelter inflation is going to remain a little bit higher than you would ideally want. In addition, there was quite a large increase in food prices, and some of that may well reflect higher fertilizer costs. And there's more and more evidence to show that within the US, agricultural prices are starting to move higher. And then if we break down the PPI data, we can see that core goods inflation at a PPI level, that moved up 0.7%, which is on the high side, suggesting some underlying inflationary pressure in a range of categories. And then equally the trade services component, which partly reflects the margin between producers and retailers, that number went up a lot in the month again, suggesting further price pressure. In terms of the tariff effect, I think the data is suggesting that there's less evidence of tariff-related inflation. The numbers did move up a couple of months ago, but if I look at the CPI reports in the last 1 or 2 months, I would say there's evidence that the tariff effect is dissipating. There's less tariff inflation evident within the data. So I think that's the positive, that there isn't quite the need for concern about tariff-related inflation, but that is now being overtaken by the concern that the energy prices is going to feed into a broader array of categories. Obviously, the US still has this massive benefit of ongoing productivity improvements, and the introduction of AI may further enhance those productivity gains. But in the shorter term, I think the Federal Reserve is going to worry that inflation expectations have moved up and will remain elevated. They're going to worry that the inflationary pressure will broaden away from simply energy and into a wider array of categories, and that ultimately they're moving further and further away from their inflation target of 2%. If we look at how pricing has changed around interest rate outlook, it wasn't that long ago when the expectation was that the Fed still had scope to cut interest rates in the second half of the year, at least once more, 25 basis points, possibly more than that. That's all changed. At the moment, the expectation is that interest rates at best will remain on hold with risk to the upside. And the reason why we're a bit cautious about the risk to the upside is that the Fed now has a new chairman. Kevin Warsh has been appointed as the next chairman of the Federal Reserve, and his statements ahead of that appointment would suggest he'd be looking for an opportunity to cut interest rates. I think that opportunity is going to be difficult to grasp in the short term because I don't think he's going to want to cut interest rates while inflation is gaining momentum. I think that would send the wrong message. But he may be equally reluctant to hike rates. So I think in the short term, we would just simply assume interest rates on hold. But if you ask me what the risk is, the risk would be that if the oil price remains above $100 on an ongoing basis, then there's a heightened anxiety that inflation in the US will worsen and that it will broaden out, requiring the Federal Reserve to re-engage with interest rate hikes, which would obviously unsettle markets. And if I look at the reaction in the bond market last week, I would say the bond market is starting to factor that sort of outcome into the pricing. There's no doubt that the bond market has become more concerned about inflation and the upside risk from here, a little bit concerned about using fiscal policy to try and support the economy. So I think the dynamic in the bond market is telling you that the Federal Reserve needs to be concerned about where inflation is heading. So not a great outcome for the US, certainly not a great outcome for the rest of financial markets, because that tends to change sentiment globally. And if I look at the performance of global bond markets, including our own, there has been renewed weakness coming through. And part of that, again, simply reflects concerns that the inflation dynamic is changing and that it could well broaden out into a wide array of categories. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorized financial services provider in terms of the FASE Act. Also, this podcast should not be construed as advice.